Hello everyone, in this video we're gonna dive into ranges. On the previous video we covered the market structure, so we can jump a step further, understanding how we're gonna work inside of a range. So let's say we have a bullish range that we know is made by a strong low and a weak high. Takes our liquidity break structure, takes our liquidity break structure. And we have our external range liquidity. We expect the high to be taken since this is in a bullish market structure scenario, right? So for example, let's say a bullish expansion. So we have our range, and the way we're gonna approach the range is simply by being guided by the key levels. So we're gonna find our key level right here with liquidity just above. Remember that the key level, in other words, is just a point of interest. So it has to follow the simple rules of catching a high probable PI. So you want to be catch from the high time frame. It has to be close to the liquidity, and it has to be unmitigated, right? So now the way we're gonna approach this range, let's say our red range is the 4-hour time frame. We can drop a few time frames. Let's say we go onto the 15-minute here in orange, and we're gonna see the structure more in detail. So we're gonna have a low being formed right here, making us a new range. So from this low to this high. Now that's why I don't call and I don't use the term strong high, strong low, and weak low. I call them just strong every time I came across them, because now you can see that the red high is a weak high following the red range. But the orange high following the orange range is a strong high. So when you hear me saying strong high, it's just because it's strong. On a way, in our perspective, it's much more easier for me to call it strong than weak. Because at the end of the day, everything is liquidity. Even my red low in a future will get taken because everything is liquidity inside the market. These terms are just more clicky for your mind to understand where the market can potentially lead into. Right, so now that you have your range, you know you are bearish because we are actually going to our internal range liquidity of our red range. Remember that the high time frame always lead the rules to the lower time frame. You have to follow always the high time frame. That's very important. So what you're gonna do is the same thing that you did on the red range. Remember, the market is fractal, so it doesn't matter if this is a 15-minute or it's a 4-hour or it's a 15 seconds, for example. It doesn't matter. We're gonna treat the market in the same exact way. So let's say we have internal range liquidity being built inside and also our key level just above. We're gonna short on our key level after price takes out the internal range liquidity and go to the target right here. Now that's very important that we cover this. Remember, we trade liquidity. POIs, or in other words, key levels, are not something so important for the range cycle. Because remember, the market floats between liquidity. Takes our internal range liquidity, goes for the external range liquidity, goes for external range liquidity, goes back from internal range liquidity. That's the range cycle. That's the way we approach the market, and that's the only way that you're gonna be able to approach the market with a lot of accuracy and a systematic way of trading. Right, so let's say in this case price miss, our PI makes a QM and forms a new range right here. And let's call this a purple range from here to here. Are you willing to take a long from, let's say, a key level with liquidity above, ask yourself this question. Are you willing to take the long right here? Or you will expect price to come lower and reach a PI? Because remember, this purple low missed the PI. It doesn't matter if you miss by a pip or you miss by 20 pips. It just missed. But you already take out the internal range liquidity. Remember, since we trade the liquidity, we are gonna take the long following our purple range, targeting our external range liquidity and the whole external range liquidity of our high time frame range. In this case, the 4-hour, the red range right here. That's very important when we're gonna cover how we approach a range. Remember, liquidity is what drives the market. So you came across a scenario like this, be aware of price potentially reacting and giving you a potential entry, making you aware the price will just miss the key level. Because remember, the key level is made for us to have a logical and a systematic way to approach the market. Without key levels, that will be completely a mess. Because once you go to the market, you will have so many potential areas that you could potentially expect a reaction. But once you just mark out your key level, there are going to be no more questions. Is either yes or no. You're just going to have one key level most of the time. You just draw it, you find internal range liquidity above or inducement in case it's a T2 type of range, and then you execute. Right. So I'm also going to give you a couple advices in order to have a range with high probabilities. We cover about the market structure, that our way of seeing the ranges, let's say we have a bullish market structure, that will be simply by strong low, strong low, strong low, and strong low. So when it comes to approach a range, you want to make sure that you have two obvious QM. Try to look only for the textbook setup. Don't involve too much logic when you do your analysis, because this will increase a lot your potential risk to do a wrong analysis, because you're trusting yourself. You're going a little bit against the rule. Because remember, the only way we're going to take a trade is once we have two obvious QM being formed. They have to be clear onto the chart before even putting our key level into it, right? So how to have a clear break with high probability? You want to wait for a strong low or a strong high. In other words, a protected structural point to be broken. This with high chances will confirm the price made a high time frame QM. So potentially you can take a short from your high time frame key level with just liquidity below it. Right? We didn't cover yet entry models and the way we're gonna place our entry or stop loss. This will be just a little introduction for it. So first thing you need to do is mark up your range. Once you have your obvious QM, you have your external range liquidity. Then you go from the high time frame, you mark up your key level and make sure it follows the rules. These just are gonna be the 2 steps out of 3. So when we comes to have a trading plan, now we have, first of all, find your range. Second one, now we have find your key level. And 3, what do we need? Liquidity just above. These are going to be our checklist. This will be the way we approach every single range, right? That's why the approach is meant to be simple, is meant to be objective, is meant to be systematical. You find your range, you find your high time frame key level, and you spot liquidity above or below your key level. And that will be just it. This will guide you inside of the range. You can focus on the main entry, or you can even stock trades. You can even ping pong. The way we're going to approach the market is with high variable setup, but we covered them little on the entry video. So we're also going to cover T1 and T2 in inside. Now this is very important. T1 and T2 are basically simple way to see a range. So for example, if you have a low right here, you're gonna have something more, let's say like this. So in this case, which kind of range you do have? A T1. And if price, let's say, comes right here and makes an inducement, or you already made a T2 with high chances to drop and then go, right? You can either remove T1 and T2. It's not going to change the way that you trade. You can even remove the ranges, talking about external range equity, internal range equity. They are not going to change. But we put all these pieces together to just find a strategy that makes sense for all of us, because it's simpler when you talk about approaching a range that you have external range equity and internal range equity. This is what makes sense to take a trade. It's very simple. It's very objective for our mind to start thinking on this way. That you take out the internal, what you're gonna do? Go out for the external. That's why we use those terms. We either use simplification, like for example, T1 inducement, T2 inducement, right? These are basically the only two traps that can come across your range, and you don't have to be confused. If you're able to identify them as traps, that's 100% correct. But you can just either call them internal range equity, or you can call them, let's say, inducement, right? They are the same exact things, but when you start thinking about what a T1 is and a T2 is, it just clicks straight into your mind. And that's how we're gonna use them to just simplify our way of trading. So that's all for the range. See you into the next one.